Wealth building. It's not just about making money. It's about creating a system that generates financial freedom and security for the long haul. And at the heart of it all are 5 essential numbers that can make all the difference between success and struggle. Today, we're going to dive into those numbers and explore how they can be the key to unlocking your financial potential. Welcome to Forever Finance, where we want to live our lives our own way. First up, we have the bedrock of financial health: income and expense tracking. Knowing how much you earn and where it's going is essential for setting goals, staying on budget, and avoiding debt. In Australia, where costs of living in cities like Sydney and Melbourne are among the highest in the world, this is especially important. Tracking isn't just about keeping tabs, it's about gaining insights into your financial habits. Many of us overlook seemingly minor expenses like coffees or takeaway, but these can add up to hundreds or even thousands of dollars each year. Using apps like Pocketbook or Money Brilliant, you can automatically categorize and analyze your spending. For example, if your housing expenses consume 30% of your income, transportation 10%, and groceries 15%, this leaves only 45% for other essentials, savings, and investments. Keeping track of these ratios month to month provides invaluable insights and helps you adjust to reach financial goals faster. Now let's discuss savings rate, a critical metric for financial security. Your savings rate is the percentage of your income that you save. In Australia, where interest rates on savings accounts are relatively low, saving can seem less rewarding, but it's one of the most powerful tools to build wealth over time. Our high living costs might make saving 20% of your income challenging, especially if you're just starting out or have a family. If 20% feels impossible, aim for 10% and gradually increase. It's less about hitting a specific number and more about creating a habit. Building a habit of saving each month helps buffer against financial hardships and is key for achieving goals like buying a home or planning for retirement. And don't overlook investment accounts. Consider saving into a high-interest savings account or micro-investing platforms like Raise, which can offer higher returns. Please let us know if you are finding value from this video by subscribing or liking the video. If you have found value from it, chances are your friends or family will too. Don't forget to share the video around. Next up is debt. Debt is something most Australians have at some point, whether it's a mortgage, car loan, or credit card debt. But managing it effectively is key to your financial health, and that's where your debt-to-income ratio comes in. Your debt-to-income ratio, or DTI, is a metric used by lenders to determine how much of your income goes toward paying off debts. For instance, if you earn $6,000 monthly and your debt repayments are $2,000, your DTI is around 33%. Experts recommend staying below 30% to ensure you can handle expenses and save for the future. If you're over that 30% mark, consider strategies to reduce debt, such as debt consolidation, renegotiating loan terms, or paying more than the minimum on high-interest debts. Reducing this ratio over time will give you more financial flexibility and reduce stress. Our fourth metric is your emergency fund. An emergency fund is the safety net that protects you from financial setbacks, such as job loss, medical bills, or unexpected repairs. When living expenses are so high, having an emergency fund is crucial to avoid spiraling into debt during tough times. Experts suggest an emergency fund covering 3 to 6 months' worth of living expenses. For instance, if your expenses are around $4,000 per month, your goal should be at least $12,000. This amount ensures you can handle sudden costs without going into debt or disrupting your other savings goals. If saving a large sum seems daunting, break it down. Save a portion every month until you reach your target. Keep your fund in a high-interest savings account. Banks like ING and Macquarie often offer attractive interest rates, helping your emergency fund grow without you needing to actively manage it. And finally, the ultimate metric for measuring financial success: your net worth. Net worth is the difference between everything you own, such as property, superannuation, and savings, and everything you owe, like a mortgage or personal loans. Tracking your net worth is essential because it provides a comprehensive picture of your financial health. Knowing your net worth is like having a financial GPS. It shows where you are and gives insight into how far you are from your financial goals. Calculating and monitoring your net worth once or twice a year lets you see whether you're building wealth or falling into more debt. You'll know if your savings, investments, and super are growing, or if you're accumulating liabilities faster than assets. Consistently seeing an upward trend is an excellent indicator that you're on the right path. Were any of these metrics a surprise to you, or do you use some that aren't on this list? Comment below and let us know if you think there should be others added. By consistently monitoring these metrics, you can make informed decisions, set realistic financial goals, and build a more secure financial future. Tracking these metrics regularly gives you a roadmap to follow as you work towards financial freedom. Check out this video to learn more about the behaviors you need to adopt in order to get these metrics moving in the right direction for you.